Hi, it's Greg here with Your Daily 5. So one of the big things going on here is we're having a bit of a brouhaha over the interest rates and where they were going. So we were starting to price in interest rates higher than 2007. And the problem with that was obviously that slowed the economy quite a bit. And then when people got in trouble with interest rates, then the economy rolled over. And we ended up having the great financial crisis. Now, I think the banks are much better situated here. Obviously, the pressure that the regional banks are feeling right now is not comfortable. But it does appear to me, or the market is starting to price in the fact that the Fed just won't be able to go higher. And the reason is because all of a sudden things are starting to crack. So in the middle panel is the momentum change. And the one thing I notice is each one of these is getting more significant in terms of lows and highs. Now, in 2010, after the GFC, it took us a few years to get this going, and it took us about 8 years of momentum to rise to the top levels. And then in 2018, we started to roll over, and we came down, and then obviously we had 2020 in the middle there. And now we recently shot up. So what the bottom panel shows is the rate of change of the Fed over a 1-year period. And the big issue for me is that it's been so sudden. If the banks couldn't keep up, like Silicon Valley Bank and others, then what does that mean for industrial companies that hadn't been able to keep up? So I'm fearful here that the Fed, the speed of the interest rate changes is changing a whole bunch of stuff. And, I talked to a divorce lawyer the other day, and he was mentioning that his clients are seeing, I wasn't his client, he was mentioning that his clients, when they're trying to negotiate the settlement now, they're in 3% mortgages. They want the house to be split. So now they need to go get a new mortgage. Well, the new mortgage is at 7%. Well, now that new rate is being trying to get negotiated into the settlement agreement. So it's things like this, like literally far-reaching stuff, because it's moved so fast that people are having trouble trying to adapt. So I'm recording this on Monday morning, and Monday, March 13th, and what we've got is the S&P 500 wiping out the gains for the year. This blue line is where we closed 2022 at. And, keep in mind this February 2nd date, because I have something to tell you about that a little bit later. What we've got here is the 200-day moving average coming down and moving flat. Now, it hasn't started to turn up yet, but it's pretty flat. And what we've got here is the 20-day had moved above the 50-day. The 50-day had moved above the 100 or the 200. So all of this looked very bullish. And now we're starting to change where potentially we could see the 20-day, which is the 1-month moving average, start to move back below the 50, telling us that things are not in bull market sort order again. And we do have a downtrend on the PPO trend lines here, but my point is in February we got up above the previous highs and we rolled over right away, and then the uptrend line we had coming off the October lows got broken late February, and now we've pushed up against the bottom of the zero level and are starting to wind down. None of that is really good technical price action for us. So the big area of interest or fluctuation right now is the bond market. And what we're seeing in the bond market is this trend that had been in place for really since August of 2020 or July of 2020, climbing all the way back up. And we had a brief dip here at the end of 2021, which is actually when the stock market topped for the NASDAQ. And early in January is when the S&P topped. And so these interest rates became significant. And so we've got this big trend line, and it's cracking right now. The other two things that are starting to happen here is the longer term moving average is still pointed out, but the 50-day moving average is starting to come down, or the 10-week. And so the 10-week looks like it's ready to cross below the 40-week, which typically is more of a bear market presentation. So we're going to watch that very closely, and we can see this was kind of tumultuous back here in the 2021 time frame. This was coming out of all of the SPACs that started in February of 2021 when they topped out. And now anyway, what we've got is this big trend line, and we're looking to see if we're going to end up with some sort of a reversal in treasuries. So one of the ways to kind of figure out how important this is to use the 10-year Treasury yield minus the 2-year Treasury yield and say, what's the trend? And obviously we've all heard about the inverted yield curve, where the 10-year has been less than the 2-year for a while. And we got down to almost 1% here difference between the two. But the bigger issue for me is on a long timeline, when these trend lines started to break. This is pretty important. So in 1998, we ended up with the Asian financial crisis in 2000, 2001. When this trend line broke, it was a pretty big deal. Then in 2006, 07, and we also had housing start to slow, and I want to talk about that a little bit, but it's the interest rate level that starts to place problems on some of these charts. So as we roll through here, again, looking at the 01 period and the 07 period, I'm just going to quickly move back to the first slide. And what you see here in the 01 period, we got to 6.5, we got to 5.6, and now we're looking, we're currently at 4.6, 4.33 on this chart, but expectations are that we're going to go a little bit higher. But the bottom line is we're up well above levels we've been at since 09, and it's this change that's making it hard. So I'm just going to quickly slide down to that slide again. And so what we're wondering is, are we going to put in another major sort of low like we did in 01 and 07? And if so, what is the timing of that like? Like, do we have a year down here where the market kind of bases out before this starts to improve? Or does this check back relatively quickly, and it's really when these downtrend lines have been broken? Now, in 05, 06, there was a really steep downtrend line like I've drawn here. But again, the market just kind of corrected and there was another full year of opportunity after that. My question is the speed of the Fed move. Is that going to give us that 1 year anymore? And we don't know that. So that's what we're watching closely, but we're sitting right here on so many trend lines trying to hold, and big long trend lines like this one in here, we do not want to see break. So that becomes more important as we go forward. One of the things that we saw break in 06, 07 was the housing market, and the reason was the interest rates just got too high for people to afford houses. And so we've had a big push up, and then we've basically made lower highs in momentum, and now we've had kind of a relief rally since, well, in October we made a higher low and moved up. And now it looks to me like we're about to go on a sell signal here for the home construction ETF. And it's too early to call, maybe it bounces off and continues to go higher. But one of the things I'm watching for here is, how does housing work out? And if we start to see the PPO on this housing chart go below zero, that wouldn't be very positive again. And if we start to see the PPO for the 10-year going negative again, I think all of these things are going to combine to show us a relatively difficult picture for investing going forward. So we want to be aware of these trends as they change. Now, I try to watch this stuff all the time when I'm doing my work. So if you have any interest in what we do over at Osprey Strategic, I'd encourage you to head over to the website. We've been on a sell signal since February. We tried to buy the market here in early March, and I just said, if we get in here and the market fails, you just want to get out with a 1% loss or whatever. And that's the whole point, is you really need to protect capital here, so we want to make sure we do that. My quick index is currently only at 2%. Again, it can get up into the 70s and 80%. It's very, very weak right now, so we'll watch to see when that turns. I'm going to be doing a presentation for how we use 7 steps to try and improve our ability to be in the market for the moves up and to be out of the market when the market moves down, and try and keep our losses to a minimum and make gains. So as an example here, you know, the financial sector's been hit pretty hard, and in my newsletter of 2 weeks ago, it was, you know, for some reason the banks aren't performing here, so we got to be cautious. Then last week, obviously, we had the Silicon Valley Bank failure. And now what we have to watch for is other areas of the market that might be suffering this financial stress. So with all of that, if you'd like to know more, we're going to host an info session on March 14th at 1 p.m. Eastern. I look forward to seeing you there. Thank you. You can register down below.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.